Once a month, Paula Pant, host of the Afford Anything podcast, answers voicemail questions the listeners send in. Here's one now.
Hey, Paula, this is Amy from Minneapolis. I love you. I think you're super awesome, and I've learned a ton from you. My question is regarding the Roth IRA contributions. So I think I've heard you say that you dump in your max right in January, and I feel like I've also heard guests say that the regular contributions, say dividing that $5,500 by 12 and just automatically depositing those on the first of the month might be a better option. Can you just discuss the different benefits of each and which might be a good plan? Thank you so much. I can't wait to hear your response. Bye.
Ooh. Okay, I get really excited about this topic, so I'm glad you asked. All right. Essentially, your question is about dollar cost averaging. Assuming that you have $5,500 sitting in cash on January 1st, is it better to put that entire $5,500 into the market today, January 1st? Or is it better to pace it out over the span of a year? Now, for listeners who aren't acquainted with the term dollar cost averaging, here's what that term means. Dollar cost averaging is the act of slowly investing into the market over a prolonged period of time. So, for example, instead of putting $5,500 into the market all at once, you would put $458.33 into the market per month, every month over the course of 12 months. So at the end of a year, both people have contributed $5,500 in total, but one person has done it as a lump sum, and the other person has done it every month regularly over the course of a year. And the advantage to dollar cost averaging is that you buy in regardless of what the market is doing. So if you're putting $458 into the market each month, then during months when the market is cheap, i.e. when the market is down, you naturally are going to buy more. Your money goes further. And likewise, during months when the market is expensive, you naturally are going to buy less. The 458 doesn't buy as many shares. So proponents of dollar cost averaging state that this is a way to achieve two goals. Number one, it's a way to force yourself to stay in the market regardless of its short-term volatility. And number two, it's a way to take advantage of those dips by buying more shares when prices are low, because naturally your money's going to go further when prices are low. Here is where the interesting twist comes in. If you have money up front, Amy, it's better to put all of your money into the market in one big lump sum than it is to hold on to that money and slowly meter it into the market over the course of a year. Now, this might sound really counterintuitive, but the historical market record actually bears this out. In 1993, two researchers from Dayton, Ohio, imagined what might happen if they converted $120,000 from Treasury bills into an S&P 500 index fund. So in other words, they imagined what might happen if they put $120,000 into an index fund that tracked the overall S&P 500. And they ran two different scenarios. What would happen if they put the whole lump sum into the market on January 1st? And what would happen if they put in $10,000 per month over the span of a year? So they ran these two scenarios, and then they ran a historic analysis of what would have happened, covering every year from 1926 to 1991. The lump sum investing strategy won 2/3 of the time. So based on historical evidence, the odds strongly favor investing the lump sum immediately. They were not the only researchers who came to this conclusion. The following year, another pair of researchers ran a similar analysis and came to a similar conclusion. And about a year later, yet a different research team actually demonstrated that there is no statistically significant difference between dollar cost averaging into the market and throwing money into the market at random intervals. In December 2001, a group of researchers then started asking the question, okay. At this point, research has demonstrated that dollar cost averaging does not help you gain more, but could it help you lose less? So they ran an analysis, a historic analysis, trying to see if dollar cost averaging is a better risk mitigation technique. And they also explained that the answer is no. In their report, they stated that loss aversion still does not explain the existence of dollar cost averaging. So, study after study after study has shown that it is better historically to invest a lump sum than it is to dollar cost average. Now, why? Isn't this counterintuitive? I mean, doesn't this fly in the face of not just everything that we've learned, but also common sense? It might seem that way, but the reason actually ties back to asset allocation. One of the reasons that it is historically better to invest a large lump sum is because during the year that you're slowly metering that money out, your whole asset allocation is out of whack. It's not where you want it to be. Dollar cost averaging is great if you don't have the money up front. It's a great way to invest new money because, frankly, you can't invest money that you haven't earned yet. So when you get each paycheck, dollar cost averaging is a great strategy for investing that new money that flows in with each paycheck, because there was no possibility of you putting that in the market before. But if you have the opportunity to put it in the market earlier, then do so, because A, your asset allocation will be in line with where you want it to be, and B, the market often moves in big leaps. There are often just a few days of a given year when it makes its big gains or its big losses. And as the historical record shows, 2/3 of the time, you are better off exposing your money to the market as early as you can. So, Amy, thank you so much for asking that question. That is a passionate topic of mine, so I'm really excited to have the chance to talk about it. I wrote a blog post a long time ago about dollar cost averaging, about this exact question, and we will link to that in the show notes as well.
Hey, did you enjoy this excerpt from the Afford Anything podcast? Then click to download our free ebook, Escape. You'll be taken to a page where you can enter your email for immediate access to everything you need to know about escaping the 9-to-5 grind to live life on your terms. And you can also subscribe with one simple click to get alerted when new videos are uploaded.